Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it's Wednesday, and it looks like we got a market. Although I'm a little bit unsure about which way this goes, but we'll do our analysis. Maybe it will become clearer. Yeah. Morning, Octavius, A. Paul, Jake. Let's go to the charts. All right. So here's the treasuries. Yesterday ended up being quite a move. Like when we had left yesterday. We were only to like this little bit right here. You see that? And it just kept going all day. So that actually ended up being a full 10 basis point move, believe it or not. So Treasury is down quite a bit. Now, overnight, there was also some CPI in Germany, I believe it was, that kind of pushed the Treasuries down a little bit further. Since then, though, it's been a lot tighter, and I would say a little bit disorganized in the Treasuries. So that's kind of the thing that makes me a little bit like, I'm not 100% sure where this is going, but it does look like some volatility that could provide some opportunities for us. So we got to stay sharp. Here's the S&P 500. Yesterday, a pretty, negative day through most of the day, and then like the last minute ramp into the close to end the day basically unchanged. But in the overnight, they have moved back down, and I'm a little bit concerned by some of the things that I'm seeing in the equity market because like Nvidia is like dragging the whole market along with it, and that doesn't seem sustainable to me. But we'll see. Here's oil higher again off of continued tensions in Israel as Israel moves through Rafah. So oil getting a pretty decent bid there. I'm a little skeptical about how long that bid will last, though. I think that eventually tensions, they complete their operation in Rafah, price will come back down. But let's see. There's always a chance something crazy happens. Gold and silver, they're still kind of in their range. So, Kappa, not doing so well this morning. But again, like the other metals, within its range. And then you got the Japanese yen. So the Japanese yen saw a little bit of curious movement. They made some like key pushes to the downside and then possible intervention coming in. So that's also something we got to keep an eye on. And then we got Bitcoin still struggling to get above 7,000 or 70,000. 70,000, right? Am I 1, 2, 3? Yeah. Anyways, so that's basically what we're looking at. Let's come over, make sure our news squawk is going here. Switch over to the other screen. Okay, so we move today to the 28th and copy template over. Okay. Okay, so flows Wednesdays tend to have more activity on them than other days. The strong move, well, let's say large move yesterday. Okay, increased volatility because we had big move yesterday. We have 7-year auction. Richmond Fed Fed at 10 o'clock. We got Williams. We've got Bostic, but those are after our session. Let's just change that to the Williams and Bostic. Later in day. And then German CPI overnight hawkish. And we got, well, beige, I don't know if I put beige book is like a huge predictor of order flow. But we do need to possible JPY intervention. Okay, so I do think that between the CPI, yesterday's move, and well, I don't know about the 7-year auction. The auctions were pretty bad yesterday. I would expect today's to still be a bit of a struggle, but maybe not as bad. So that could kind of stem the bleeding. So I think that what I've got here is flows maybe slightly biased to the downside, with possibility of strong upside flows coming from Japanese yen intervention, etc., etc. When I come in and I look at the current flows, though, we have a pretty consistent, for the past 37 minutes or so, pretty persistent order flow going long in all three instruments. So that is probably enough on its own to get me in here long. But since I'm unsure about the larger, like my predictors of order flow, and I don't think that I will necessarily get in yet. But let's kind of watch it, because it does kind of... So 16 is a spot that I'm always a little bit wary about, because they really like to trade that price. So let's kind of watch it here, see what we think of what's going on. Right now, there appears to be low latent liquidity at 15. They're trading back and forth across that price without having to trade a whole lot. Blow my nose here. Let's see here. Forrest says, good morning. That sounds like a familiar name, but I think it's been a long time. You need to refresh my memory, perhaps. So what I'm watching here is I want to see, when I look at cumulative delta, it looks like the market orders are pushing. So what I would like to see, or what I would expect to see, rather. Okay, so there was 1723 on that uptick. So that was a little bit of a change. But I would expect to see the market orders come into 15.5 and lift that, and to see a few thousand contracts trade. If they just pull and we trade up on only like 500, okay, like we just did there. So that kind of tells me something. It seems to me like the market makers are afraid of taking on inventory on the short side. Okay, but you know, that doesn't tell me as much as I would like about those market orders, right? Because I want to see, oh yeah, even if they put something up, those market orders are willing to plow through it. And I'm not seeing that yet. Does seem to be across the board though, and maybe some steepening happening in the yield curve. So I need to keep an eye on the 5-year. The 5-year might see more buying. The 30-year might see more selling. Even though right now it's across the board that we're seeing changing cumulative delta. Oh, you're never awake from my stream. Otherwise, I'd be here way. Oh, okay, I get you. I think I can recall like some comments and stuff you've made on YouTube now. We talked a lot about finding edge in your video. You said it sounds like I say everything you want. Oh yeah. I definitely remember that. I think it's, well, because here's the thing. Here's what happens is I'm really obsessed with this idea that your mind works very similar to the way that machine learning algorithms work. Like it is a neural network. And so like a neural network is basically you get this matter up there and then you pass data into it. And as you pass data into it, the network adjusts itself to process that data. So what we're doing here is we're sitting and watching the market is kind of that data to train on. Now, something that's kind of important in that training is like the order of things. Like the training model, learning certain lessons earlier can like really benefit it. So if there's a certain lesson that we know is really important, we can pass it data sets at the very beginning to ensure that the network learns those things, right? Well, what happens is most retail traders come into trading and they immediately get absorbed in technical analysis. Okay, that was a good lift there at 16. So that kind of suggests to me that we are still getting that persistent imbalance long. I think that I'd still have to choose my spots, but 15.5, 15 doesn't look terrible. Anyways, so a lot of the people, when I see it come in and the kind of questions that they ask and so forth, I often get the immediate impression that, okay, their neural network has already been tainted by incorrect information and if we cannot correct that information, then they probably don't stand a chance. I think that's why, like, large trading firms, banks in particular, would much rather get somebody that's untrained. They would much rather have somebody that, has been taking university classes on this sort of stuff, but is not necessarily some like strong technical analysis retail trader or something like that, because they feel that they have to completely retrain them. And sometimes they can't do that, right? So when I get people like you, Forrest, that comes in and they ask the right questions, which is like the natural next step based on what they're, things they already know that are true and correct. And that says, okay, this is somebody that can go far because they're in the right spot, right? The questions you guys ask me tell me a lot about where you're at. Do you ever have a long, short bout? Yes. Well, so that's what the purpose of this is to do, right? So I didn't write it here, but I'm going to say bias slightly to downside with upside surprises. So sometimes I'll come in here and I'll be like, everything that I'm seeing is to the downside. Yesterday, we had a bunch of things that were kind of unclear, but they all ended up being short, and so it was to the downside. So that was a case where the flows were very imbalanced, but we just weren't able to predict them, right? But if I come in here and sometimes you can just see very, very strong bias to the downside, that's when we'll come in, take a trade, and just hold it all session, and it turns out, and then it's like, okay, how did you know that it was going to go up or are you going to go down? Because there's nothing on the chart that would have told you that, right? But what we're seeing right now is kind of different, because my reading of the flows is kind of maybe slightly to the downside, but we're seeing a pretty persistent meta order long. So this is why I am being a little bit cautious. I'm concerned that like you're going to play around 16 for a long time, maybe have like a temporary breakout, and then suddenly see the flows flip around, right? That's kind of the possibility. Because if, let's just say that you're a large firm and you want to sell and you haven't started doing it yet, right? You're going to look at what's going on here and you're going to like, okay. Like I can like, hold some offers out here, get some fills, but just kind of let these guys that are buying it, let them be in control. Let them be in control, push it up, because that's going to give me better prices, right? And then when they're kind of done, then I will have to sell it back down and create a hole that I can execute in, right? So that's why we got to be a little bit cautious. We got to pretend that like somebody does know, somebody does have a large amount of order to execute short. And in that case, what would you see? You would probably see like a false breakout and reversal. How to stay true to your input by not inputting information you want to see compared to what actually is or has happened, bias confirmation sort of a thing. That's a good question. Well, so, I don't find too often that the things that we are looking at, that we are most focused on in terms of the flows down here, are that vulnerable to these kinds of confirmation biases, particularly like political confirmation bias. And the reason for that is because some of the strongest flows in the market have like absolutely nothing to do with like the fundamental picture out there. Like the fundamental picture is really important, but that is something that really emerges on a longer time frame. And on our intraday time frame, a lot of the most of the things that are the strongest have like nothing to do with anything. It's just like, equities were up really strong that month, and so the rebalancing is going to be they have to sell equities and buy treasuries, and that has that has nothing to do with whether Joe Biden is competent to be president or anything like that, right? And so all I have to do is make sure that I get all of the flows, right? That I really know enough about the market and what's going on to be able to predict those flows. I think that the hard thing about the way that we are trading is really knowing when you know, right? Sometimes you'll come in and you think, oh, based on this and this, I think that the flows really should be short. And you're right, but you're not 100% confident about it. Like right now, I think that the flows overall are going to be short with upside surprises, but I'm not seeing the Japanese yen necessarily experiencing a super strong up move. That upside movement in the treasuries could have been because of the Japanese yen, though. And in fact, I think that's a most likely suspect for that long flow. Okay. But there's all these other things to the downside, right? So do I actually know? I'm not sure, but it may turn out, an hour from now that we go, man, Seth, you really nailed it. The flow was to the downside, and we really should have just put everything that we had into going short, right? Like knowing when you know is the difficult one. And I think that really only comes from experience, right? I found a trading opportunity and requires coming up with the best inverse risk reward strategy possible while technical analysis has no power in predicting future orders. Do you think it can be helpful in creating a high win rate strategy for this, or maybe incorporating order flow? We've been using NinjaTrader Strategy Analyzer to help. Well, so the big thing that I've found in backtesting intraday strategies, like the most significant factor is what you set your stops and targets to. Basically, your profit taking strategy has a stronger effect on the results that you get than almost anything else, which kind of suggests to me that your entry conditions based on just price and things like that aren't really very effective at predicting future moves. So if it is a random market, then that would kind of make sense that how you decide to take profits kind of matters more than anything else. And it tends to converge on break even on a risk adjusted basis. So the way that you figure this out, where's my pen? The way that you calculate this, I have a nifty little formula. I'm not going to derive it for you. You're just going to have to trust me. The break-even win rate. Hold on here. Okay. Break even percentage is equal to 1 over 1 plus R, where R is equal to average win over average loss. Okay. So if your R is 1, that is your winners are equal to your losers, then the percentage is going to be 1 over 1 plus 1, which is 1 over 2, which is 50%. Makes sense? All fits? Okay, so if you have a strategy where your loser is significantly larger than your winner, right? Say 1 to 2, which is very, very common among retail traders, then your break even is 1 over 1.5, which is equal to basically 66%. So that means to break even, you have to win 66% of the time. But again, it will tend to converge on that break even. So what you will usually find is, actually, you do win 66% of the time. Actually, I'm going to bet you, if you do a strategy like that, that you will get a little bit higher than that. That most of the time, your win rate will actually be more like 70. You'll win 70% of the time. And that comes to the second kind of rule I've found. And I don't know how to prove this one mathematically, but it's just, if you make this assumption here that you will tend to converge on the break-even win rate, then the lower your R is, the more that fat tails factor in to your end results. So low R will tend to perform, like better than the break even most of the time, and then you'll get a period where it just does dismally, and that's what brings you back to break even. Okay, so to deal with this, most retail traders will have a daily risk reward. I can only lose X% of my portfolio and then have to stop trading, which helps, but it I find just kind of delays the inevitable. Eventually, you come to a period where there's a month, quarter, or even years where the strategy just doesn't work very well. Something that worked like every time, and all of a sudden it's like 11 losers in a row. I don't. Almost every Ninja Trader strategy I've ever back tested has a loss streak of at least 10 trades in a row, which it can't be random, frankly. Like the chances of having 10 losers in a row are really, really low, and yet it happens almost every time. So that's the market at work, right? That's where it kind of tends to converge on break even. Okay, so that's the first thing, is that most people will come in and they will use this low R factor and think they're doing great, but really it's just kind of fooling them, because they only care about what happened over the last month or the last year, and they can't see the bigger picture, right? Now, I think that there's a lot of ideas, and I think that to some extent they do make sense, where we say, okay, actually, let's come in and look at like what should be happening here, and then that's like actually the opposite is what's going to happen, right? That kind of logic works pretty good when you are in mean reversion action, which is to say that there's not actually anybody actively executing out there. Then it's just the market maker in control, and the market maker basically just plays games to screw you over. The problem that I've found, though, is that like the market maker can react to what you do. So if all of the retail traders catch on to his trick, then he just goes, oh, okay, I'll just do the opposite side and then screw you over that way. Right? Yeah, I've only tested about a year and I almost always get around 70% win rate. 83 to 20. Well, see, that's why I say express it in R factor. In terms of R factor, your average winner divided by your average loser, right? Because people will say, what's your risk reward? So then it's the opposite. It's your average loser over your average winner. And when you try and express it in terms of that, there's not a whole lot of math that you can do with it. I kind of wonder if the reason it's risk reward instead of reward risk is so that you don't find the math. maybe there's some rules in English that make risk reward sound better. But that's why I call it R factor, average winner divided by average loser. So if your average winner divided by your average loser is 1 to 3, then you're going to have a win rate of like 80% to break even, right? And you're going to be very, very vulnerable to fat tails. In fact, once you get to those points, it can be multiple years until the fat tail appears. Have anything in your indicator, Brendel, that might help with this? Well, I guess the larger thing is that, again, I have never found anything that you see on a chart on an intraday basis that is very effective at predicting what it's going to do that day. Just doesn't. That's why those things kind of come out. Now, you can do more complicated things with your risk reward, right? For instance, stop and reverse. Stop and reverse is a great way of doing it. Stop and reverse would be, okay, I have a signal to go long and I have a signal to go short, and I am just going to stay in until either my target or my stop is hit. Or no, I'm just going to stay in until I get the opposite signal, rather. Okay. So what that's going to mean is that now, instead of all of your winners being 4 ticks and all of your losers being 8 ticks, you're going to have some winners that are 1 tick and some winners that are like 16 and 32 ticks, yada, 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 right? And this kind of allows you to take better advantage of some of the wild distributions and fat tails in the markets, right? So if you can come in and you can do something like that, where when you catch a winner, like they just really, really, really run, and when you catch a loser, they get cut off very quickly, and you're able to still maintain a favorable win rate under that scenario. That's where I get strategies and statistics that are a little bit more interesting. But still, I haven't found one that, like, over 5 years of data, like, really performs well. Now, when I go to higher time frames, and I do things on daily data across the portfolio, then I find things. That's why kind of the idea that I've been teaching and pushing a lot, and this is why I have my most recent video about momentum, is to teach people that, okay, well, you're all focused on technical analysis because you've heard of people that made tons of money from like there's these fund managers and stuff that they're using technical analysis, right? Well, yeah, but not intraday. They're doing it over daily time periods, and they're holding positions for months. Completely different game. So once you get to higher time frames, then I see more value in that stuff. But when we're coming on the intraday time frame, we want predictors of order flow, pieces of information about the market that will suggest that there will be future orders, long or short. Yeah. I need to take a quick break, so I will be back in like 5 minutes here. It's hot in this room. I gotta fix this. Well, I think that I may have to like change all my vents. So I switched my temperature from like hot cold to just only cold now. But I think that like the vents and stuff, I need to like close all of the vents in the basement and open all of the vents upstairs, and so it cools down. It's a little hot in here. Let's see here. I missed a comment here. Marcus Lee, are you using the Dom to scalp or to hold longer than 1 to 2 ticks? If you're scalping, when do you know when it's time to take a trade, and what stops you from staring at the Dom? Okay, so my ideal trade would be I get in a trade before 7 o'clock and then I hold it for 2 hours for like my whole trading session, and it just keeps going and going and going. That would be like my ideal trade. So how do you know when it's time to take a trade? So I have a prediction of what my flows are expected to be. As soon as I see strong evidence in the current orders that that scenario is playing out, I want to get in with some consideration to where possible liquidity holes are, icebergs, and catching the edge, right? So let's just say we're not getting this right now. The volume has gone flat. Like essentially we had a meta order to the long side, and then it stopped and we reverted back to 14.5. So if I wanted to go long, probably anything below this like point of control as of late, so 14.5. Okay, once you get a price that's traded like that a bunch of times, it tends to get stuck there for 45 minutes or so. So anything below 14.5 would be okay for the long. Obviously, it's kind of going down, and like maybe my scenario short is starting to play out. I'm not seeing it in the order flow yet, but we are moving down. So I would prefer to be short above 14.5, but maybe that's already passed. So then what can I do? Well, okay. The bid and the ask right there between 13 and 13.5 are even. So that doesn't help me. But maybe 13.5 is like, you know, really low, and they're just trading back and forth across 13.5. Then it's like, oh, okay, I would rather be, okay, so like there's only 126 there now, right? Okay, so I could probably get filled at 13.5. So I would rather put a limit order at 13.5 than to hit into 13, right? That saves me 1 tick. I might be able to get 14, but that would be kind of hard, right? So if they're, you know, if they started executing into 14 and there was like a big iceberg there, I might join that iceberg and be short at 14, and then that gives me 2 ticks, right? And those are the sorts of things that will help me get a better position. But bigger picture overall, I want to get in as early as possible once I realize that I'm starting to see the flow that I want to see. So that is to say that, like, again, the exact price that you get, like finding an edge in that, really hard. I haven't found anything that gives you that, really, other than those, you know, catching the edge and icebergs and liquidity holes, right? And that only helps you so much. So it's better to just be in early, right? Well, sorry. So when you say only win rate, are you saying you want to have the highest win rate possible? Because your average stop as compared to your average winner is going to be the strongest predictor of your win rate, right? But that's why I'm bringing up, I'm going to guess that you're probably going to get screwed by the fat-tailed nature of markets, right? That's interesting. I was under the impression that the DOM is predominantly used for scalping, so it's interesting to see that a screen full of DOMs doesn't equal scalping. That's a good point. Well, traditionally it is used for scalping, and traditionally you do use those kinds of strategies like catching the edge and playing with icebergs to just take a tick out of the market. I think that you can still try and do that, but for the most part, you're probably going to break even. So it's just like really hard to play that game because the robots have taken all of the edge out of it. You know, like most of the stuff that we learn that like is traditionally taught to retail traders about the DOM are basically come from ideas that were developed in the early 2000s before the robots came. By 2008, the robots had taken over essentially, right? So now that the robots have taken over, we kind of have to adjust. And so the way that I adjust is I go higher time frame, essentially. So that doesn't make the information that we have on the DOM useless, right? It's just that, okay, that kind of like gets me to break even. And then my edge, the thing that puts me over the top, is having a better understanding of the flows in that market and being able to predict those flows, right? So the DOM is the best way to see the orders, the best way to see like what orders are actually being put into the market on a, you know, trade by trade basis. So that's why we want to have the DOM up and look at it. Nothing else shows you that as well. Second best thing would be cumulative delta. You can't have a DOM and all you can have is a chart, then you would want to have cumulative delta. Is there a specific why you prefer to hold with the DOM? Well, I tried like, getting one tickers or like, risk 4 to make 4, like to try and take the average range of a 30-minute period or whatever the deal is, right? And it just wasn't working. Over time, I realized that those things simply did not have enough edge for it to work. So, out of necessity. Anyways, what was I gonna say? Oh yeah, on the risk reward thing. So if I have a really big stop and a teeny tiny target, like I'm only trying to make one tick and I hold a stop that's larger than the average range, like over here, I have this indicator on here that shows you like the swings. So you can see that it's like between 4 and 7 ticks is a swing before it turns back around, right? So you could come in and you could say, okay, I'm going to try and take 2 ticks and I'm going to make my stop be 8 ticks. Then I'm very unlikely to get stopped out of my trade unless like a really big move comes in against me all of a sudden out of nowhere, right? And I might know enough about what's going on to know that we're likely to be range bound here. And so, me making the 1 or 2 ticks there is really likely, and me losing 8 ticks is like extremely unlikely, right? You're going to get a really high win rate, but again, very vulnerable to fat tails. So I don't know what it is that makes you think that like having the super high risk, the super high win rate is more advantageous for you. But again, you're going to be very vulnerable to fat tails. And so it kind of tricks people into pursuing that direction. The other thing I was going to say is that I do have some considerable edge in terms of determining when to take your profit, right? Because if I'm expecting a move, I can predict how many orders the move is going to be. I can come in here and I can say, okay, cumulative delta has been going flat here. We're expecting to see some flows come in short. The flows that I would expect to see come in short would maybe be 20,000 contracts. So if I see this cumulative delta go from negative 19 back down to negative 40, and then kind of pewter off, that's probably where I'm going to take my profits. If, on the other hand, I'm expecting multiple legs, I might hold through those multiple legs until I get the amount of volume that I'm expecting, right? And when you create these liquidity holes like we have at 13.5, we can see it pretty well now, right? They're not putting up a whole lot on the offer. If it ticks up, they're not putting that much on the bid. A little bit stronger on the bid than the offer, but it seems a little low. I bet you that if they tick back down, that it'll probably be less than 500 contracts. If there's not, then that kind of signals to me that there's a change. But, we're likely to rotate around that price for quite some time. Right? So, doesn't really make sense for me to get into a trade. And if I was, going short, that is probably a good place to get out, just because I know it's not going to go any further. At least within the time period that I want to be in it. I mean, I can't really comment on somebody else's edge, right? I've never been able to see, what is John Grady's total performance, right? I know a lot about his trading style. I've taken a lot of his, I took his basic and intermediate courses. People have shared with me a lot of information of things that they saw when they took his webinar. I can't say if it has edge or not. All I know is that when I tried doing it, it wasn't enough. And I've gained further insight from studies and so forth, complicated math, some things that I think kind of support some of Grady's ideas, but some ideas that go well beyond what he talks about. And when I combine all of that information together, it kind of suggests to me that the DOM alone is probably not going to be enough. So. You had to choose, would you go for 4.33R trades or 20.06R trades? Oi, no. I think that if you are trading with discretion, that it's best to not go under 1. To not go for an R factor under 1. If you have an R factor of 1, that's going to give you the best, most up-to-date feedback about how you're doing and what the market is doing. And when you start to get those R factors below 1, it starts to trick you. It starts to go, oh, you're so great, you're winning every time, even though what you're doing is completely boneheaded. And this is why I really think this is one of the most significant factors behind why retail traders struggle, is because so many retail traders fall into that trap. Oh, no. We have this stream set up so that new people can come in and ask questions and get the attention that they need. I always tell them, there's this thing on Reddit. So, oh my gosh, did you guys hear about this Google leak? So, internal secret documents from Google outlining factors in Google's search algorithm were leaked to the public. And this paper goes through some 1,400 different factors that affect your search ranking. Many of the things that factor into the algorithm are things that Google has multiple times in the past explicitly said, oh, don't factor in. They lied to us. They lied to us big time. And one of the things that factor in are posts on Reddit. So basically, something that I see happen a lot of the time, by the way, we're breaching the lows here now. We have broken away from that that liquidity hole at 13.5. I'm seeing a little bit of selling, but it's only like 1 bar, so it's a little bit early for me to be making too big of a conclusion. But I might be able to go short here. I'm feeling a little uncomfortable. So something else I need to factor in here is that I am probably going to be twitchy today again. So I think if I do this, I can only take like 1 if it's not a winner. Right? I don't know how I feel about the level 2 here either. Okay. So I would much rather be long from 4575. Anyways, so what people will do is they will go on Reddit and they'll say, hey, what is your favorite YouTube trader? Right? And then everybody in the comments will like comment who their favorite YouTube trader is. And you pay a bunch of people to say, oh, my favorite YouTube trader is Speculator Seth. And then those people all upvote that. And so that comment goes up towards their top. And then all of a sudden the YouTube search algorithm goes, oh, Speculator Seth is the guy. Totally effing happens. If I was in charge of the day trading subreddit, I would ban threads like that. Because I'm completely convinced that they're all just manipulation. But one of the things that's nice about this stream is it's relatively small and niche, and if you're new, you can get your questions answered. So I always tell you guys, like, the first rule of Speculator Seth is you don't talk about Speculator Seth. I go every one of those threads on r/day trading. I go and I read them, and I'm like, all right, does anybody mention me? And so far, you guys have been good. You're not breaking the first rule. So good job. See, Octavius is short. I would have thought that he would be short. They kind of like ran into a wall there, and it's kind of petered out. But I think that there could be a little bit more here. I'm just trying to figure out how I feel about where to take it. But suffers like something's wrong. I guess I don't have the order column turned on. That would help. How about that? That's a little better. So it seems that we're seeing some volatility here in oil. I haven't heard anything on the news squawk. Treasury seems to be taking a breather at 12. Finally found, no, you did not. You did not find a YouTube with live stock trading. There are many streams out there that will do live stock trading, but we are trading futures. This is my best idea, researching right behind working towards crawling social media. Well, okay, so there's been a number of academic studies about looking at sentiment as expressed by social media as a predictor of movements, and they found that it does a pretty good job. The issue right now, though, I think, is that all of those studies were done on Twitter because Twitter had a super open API and there was lots of activity on there. Twitter doesn't have nearly the amount of activity from traders, and the API is not completely free anymore. So the opportunities to do that have probably, I don't know if it's as good anymore. So up here on this one, I think I can so with up here, I can kind of split the difference. It's down here on the live account where I kind of have to be careful. I could hit, well, let's try it. I could try hitting this right here. We'll see if that fills. I'm kind of skeptical that that'll work though. Okay, so that was a good example of what I was talking about, where I know because the latent liquidity at that price is low that I'm likely to be able to get a fill at 12. Whereas this one at 13, I'm, a lot less likely to happen. I'll leave it there, but it's unlikely to happen. Down in here, I could... Oh, it's still not... Oh, okay. I need to unlock it. Does that fix it? No. There we go. See, I could try putting my order right there. Okay, they're front running me. Don't like that. Did you see that where it was like it was 20 and then I put my order there and all of a sudden it was like 40? Okay, yeah, 42. So 577 would have worked. So what I'm seeing here, okay, well, there you go. Never mind. It's too late for me to say it now. I was going to say what I'm seeing over here in the micros kind of suggests that the direction is that they're going to continue. Yeah, there she goes. It was like 2 ticks all at once, wasn't it? Because I was just noticing that like the treasuries had pulled back, but the micros had not. So the micros were still like, yeah, we want to be long. Now that was kind of a little bit of a jolt, so they might come back up to that 12. It wouldn't be too hard. Let's just see if they continue or not. Now 11.5 is kind of being the back and forth. So if I was only looking for 1 tick, that'd be a great spot to just take the 1 tick, right? Because I get fill very easily I can just hit into it. Whereas getting to fill at 11 right at the moment looks a lot less likely. They're probably going to have to hit it. Like, they're probably going to have to trade 3,000 contracts to get through that. Are you ready to see Trump go to jail? Oh man, I don't know. I haven't thought about it a whole lot. If they, it seems to me like my reading of it, and I don't know how accurate or effective that would be because I haven't been like hyper engaged on it or anything. I'm not one of those people that watches every moment of the trial and catches every play-by-play. But the synopsis that I've heard from both sides of the aisle is that the prosecutor's case was really weak. So I would be very disappointed if they convicted him and sent him to jail. But if it happens, but there is still this kind of thing where it kind of seems like it's all rigged against him, and that the intention is to get him to go to jail. Yeah, like it really seems like the fix is in. I tell you what, Joe Biden holding a campaign event yesterday in front of the court, like, so totally gives it away, right? Like, it's totally a political thing. Like, their strategy is you make him look bad by trying to throw him in jail with a judge that's favorable to you, and I can't, if I was in charge of a campaign like that, I would be staying as far away from the courthouse as possible, because otherwise it's going to look like, I'm trying to influence it and stuff like that, right? It's just like with Joe Biden, man. It's like every decision that he makes, I feel like is the bad decision. And it's so cynical. You know what I hate about Joe Biden is that he's more politically cynical than Donald Trump is. And Donald Trump was pretty bad on that, right? Donald Trump is like, here's something that I can do that will help me, even though it's kind of a dumb idea. Okay, sure, I'll do it. It's just all in on that, right? And I hate that. You can see it here on the YouTube. Oh, putting a big number on my thumbnail will get me more views? Yeah, I'm not going to do that. So I don't think that it's good for people, and I don't think that it would be very honest, because that would be like suggesting, oh, so you too can make $1,000 a day, and probably you don't. Probably you lose everything you put into it, right? But Donald Trump, he was, whatever you do to get the attention and everything, right? And Joe Biden just takes it to like another level. Oh, okay, so we can weaponize the justice system against him? Yes, let's do that. Well, all in on that. Oh, we can import voters? Okay, we'll do that. All in on that. Doesn't matter what kind of negative effects it has on border states and local municipalities. They have to deal with the influx of people. We're just all in on that, right? And he's worse than Donald Trump in that respect, and I just absolutely despise it. Yes, Biden has a national cut-in scheduled for the verdict. It is like, so I don't know if that means that it was predetermined. I think there's still a good chance that they find him not guilty. I do. I think that there's still a good chance they find him not guilty. So. I don't know, guys. This one is kind of looking like a dud. We did get a couple of strong downticks, but since that time, the flows have been kind of flat. And even if I had gotten the price that I wanted, like 575, I wouldn't have even have gotten 5 ticks. Yeah, I think with the win rate, like one the like I think the kind of like for scalping, like the optimal scenario is you have equal risk reward and still have a high win rate, right? Like if I have equal risk reward, then my win rate should be 50%. But if you have something where you have equal risk reward and you're winning 60% of the time and maybe scratching or breaking even 20% of the time, and you're only losing 20% of the time, that's golden. That's a really effective strategy that is likely to be sustainable and so forth, right? How can you do that? Well, the most likely scenario to get that sort of a thing that I know of is statistical arbitrage. Look at a correlated instrument or a group of correlated instruments and find which direction the flows are going so that you only trade in line with those flows, and then find a situation where it's ticked up further than it should and take the fills and take a tick off of it based off of arbitrage. That, you know, this ticked up, but this correlated instrument didn't, so I'm going to take a fill short and take one tick. That's how I would go about creating a strategy like that. Okay, that's not too bad. It's now 11.5 goes. 11.5 is still kind of doing the being a little iffy. So do you see these guys that are putting bids at 4.579 in the micro 10-year, and they're not getting fills? Well, now you could take them at 5.79. Yeah. Sort of like Gary, but with flows supervised. Well, but I think that Gary kind of teaches you to look at those sorts of things, right? That's just like I think that the innovation that I've taken here is I've taken some empirical studies and I've just kind of applied them to, you know, retail day trading and kind of laid out a process for you to follow. Because Gary and all of these other kind of order flow traders that you're probably more familiar with, they've always said these sorts of things. It's just like they don't have very good language to describe it. Like John Grady always says, it's like the context matters. Yeah, in this situation, this one is a good trade, but in this situation it's not, and it all just kind of depends on the context. Well, what actually is the context? I say that the context is predictors of order flow, and here's a method for you to go through and say, here are all of the predictors of order flow, and ergo, like, that I can generate a context and to tell me what kind of trade I want to take, right? I don't know about this. I really hate like buying into a high. Yeah, look at that. I should have done it. I should have done it. God dang. Gosh dang. Well, up here I got it right. All right. Part of my problem down here in the micros is I just feel like I have to be so darned precise that. Okay, now we would have gotten $10 off of that. So remember when I said this like almost an hour ago? I was like, well, right now I'm not too sure, but it may be in an hour that we say, oh wow, you really called it, right? Like, hey, this flow to the upside, it doesn't match with our predicted flows. We got to be careful because it might kind of like peter out and then this sell come in, and that's exactly what's happened. I wish that I had been able to catch a good spot on my live account, but I was just like a little bit too hesitant. I think it provided me some opportunities and I just didn't click. So that would be mistakes on my point. I got it up here though, right? Like if I had at the same time I'd put that one in, I had said, okay, let's just do it. Then I'd be up 5 ticks by now. Actually more than 5 ticks. Now, I am starting to see them maybe possibly taking a little break here. But you know, like I said, it'll probably be like 10 to 20K. Well, that was 10K, only 10K. So there could be more flow short. And we haven't formed a really strong liquidity hold down here yet. So like I'm going to hold this one. You know what? Maybe I just don't take a live trade because, like, again, today I'm supposed to try and max out my snatch today in weightlifting. So my nervous system is going to be a little bit, you know, more higher than normal, I guess you could say. I don't like trading when I do that because it makes me very, very, like, I've taken really bad losses in those situations because you just want to take a trade. So maybe it's better for me to just, you know, run with the sim trade that I took. Look, there's another 5 ticks though. And a pretty big iceberg at 10. Gotta be careful. So I don't think that they've, like, completely stopped out the longs yet, so. There's another iceberg at 09 though. Do you have any videos on correlations? So no. So I wanted to make a video on correlations, and I just had a really hard time, like, trying to put together a real video that I thought would do well on it. And so instead I put all of that stuff in the strategy PDF. So if you go to speculatorseth.com/strategy.html, you can get a PDF file emailed to you that, like, goes into detail about all of this, and it talks about correlations and the kind of correlated flows you'll tend to see in certain contexts. Okay, so I don't like that they've come up 3 ticks from that low. I guess if I was long 485, I would still be okay. Market order imbalance is approaching 30. And that's the level that we've identified as kind of, like, pretty high, right? But I wouldn't expect, okay, so now it's coming back down there. I wouldn't expect it to reverse here, right? I would be expecting it to pause. If not, go a little bit further. I don't know, it'll be a good test for us, huh? Yeah, those bids look flighty. Yep, only 382 to take 09 offer. Not a strong offer following it, but that's still kind of in line with what I'm expecting. I think that these prices down below, like 8.5, 8, 7.5, 7, you would probably need to see a lot of orders trade in order to clear them. So I think that you'll probably see, you know, 3,000, 3,000. And that probably causes it to pause. Basically, it would kind of depend on how big this meta order is now, because we are now to that 40,000. So, so this is a little bit earlier than I usually try to take it. I'm thinking about possibly taking a profit. If I had multiple contracts, then I would definitely do it. But I only ended up with 1 contract short, unfortunately. Yeah, okay, I will, because there's an iceberg. So, like, we're getting to the amount, like, this was the amount of imbalance that I figured I could have expected. I'm not saying that it's not going to be more. It's just like, that's the easy call. It's like 20,000 contracts short. Okay, and there's an iceberg, so probably a good spot for me to take a profit. Let's see if it goes further. yeah, they are hitting that just barely at 08. They were hitting that fire stop out zone, yeah. And they usually go through that by a tick or two, but that was also a factor. Although I don't think I was explicitly thinking of that when I put it in, but I did know that that had happened and it was kind of in the back of my mind. So maybe that, I don't know. Some of that was by feel. We'll see how good my feel is, right? Like they did trade 08, right? So, yeah, and I disarmed that. That's okay. Yeah, I could have made 20 if I just, like, when I first started thinking about it, if I had just taken the 575. I'm just, like, with my live account, I'm just way too risk adverse with it, aren't I? Because I've been doing really, really good with these yen ones. But I think the problem is that it's like the spot that I get is, like, matters so much to me down here and is really hard to get. You know, like if I say, okay, I would like to buy it at 593, you know, what are the chances of me getting filled there? I don't know. I just don't do anything. So I need to do something about that. I guess it's okay because it's the summer and everything. I guess another thing is that what really matters to me more is you guys, and that I'm giving you good, empirically backed information about the market and kind of like showing you an approach that actually has some real information behind it. And today was a really, really great example, right? We came through, we listed out our flows. We said, well, there's likely to be some volatility. Which direction will it be? We summed up all our flows and we said, okay, it should be to the short side. So then we came and we looked at the flows and they were not short. They were long and then flat. And we said, okay, that's not what we want to see. So let's just wait for it to possibly go short. And then we saw that. I took it with a sim order. And it turned out. So this is another great example of the approach working really, really well. The crux of it is just knowing the flows and being able to predict the flows well. So I can be happy with that, even though I didn't take it live and make $20. You think it's keep going? No, I think that if I would maybe have, if I was hanging on, maybe I would be holding out for 4.6. But this is definitely slowing down at the very least. It's like Uzi is saying, like, because we're like down to 30%. So basically what that means is 70% of the market orders have been shorts, right? You start to get backflows, and you can definitely see it in here. People taking profits and market orders going the other way. The cumulative delta, you know, leveling back out. You can see over here. See how the last few bars, it's just flat. By the way, the yield curve is continuing to steepen here. TLT is filling a gap from the beginning, so just bought another share, so maybe she keeps dropping. Oh man. Well, you know, so let's go higher time frame here, huh? Excuse me. I need to clear my throat. Right, so treasuries on a daily basis. Okay. So when we were coming down here in April or so, right, we started to get some pretty strong momentum to the downside, and it came back. And now, so we're well below this kind of spot. Interestingly enough, like our mean reversion kind of indicator on a daily basis, down at 107.25 half, that's only a day or two away. Then we see if we breach that. Like, so basically, on a daily basis, what I'd be concerned about is this area acting as support again. I feel like that these 2 days of downside action are a little bit of a surprise, right? Like, I obviously the flows are all in line, okay? But if I wasn't looking at the flows and I was just kind of trying to judge things based on a daily chart, I would have been surprised that those 2 days came in like that. So I guess what I'm saying is I want to look for momentum. I'm not sure that I see a really strong setup for momentum yet. They're going to have to break through that 08 really convincingly. And then they're going for the shots at those yearly lows. And in order for that to happen, I think that you would have to say that there's a really strong, really strong shift in narrative. And, you know, with like Kashkari speaking and the auctions being really terrible, maybe we have had that shift. Maybe it's possible. But I think that we have a few reasons to be skeptical about how far this one can really go in the longer term. Today, for all I know, it's just going to keep going. Although, again, I took profits because it got to the level that I was anticipating, at least. Probably. It does look like it's paused. I mean, you got a little bit of a pullback. Yeah. So it kind of like it went flat for a few bars, and now we're pulling back. It's only a 3-tick pullback, but it is a pullback. Inventory cost basis short is 12 at the moment, although that will almost certainly come down as we go along. That will probably come down. So they might, I could see maybe 11.5. Probably more like 11. Probably more like 11. That would be funny if it just like immediately goes up there and tags that. Yeah. So my profit taking was pretty good, yeah? Wait, where did I get out at exactly? Why not have one of those windows open? Come on. It doesn't tell me what my last bid and last ask it was because I didn't have it open. So it was 12, 1, 2, 3, 4, 5, 6, 7. Okay, so they went 2 ticks further and then we got out. So I would say that's about as good as you could ask for, right? I read that really, really well. And what makes me happy is that I was able to predict that overall flow really, really well. That when we got to like negative 40, that was probably about as much of an imbalance as I could reasonably expect in that situation, and then almost immediately it flipped back around. So don't go and tell everybody though, okay? First rule of speculator Seth is we don't talk about speculator Seth. It's interesting that you're running like a 10-minute and a 30-minute and all that. But I guess that's probably partly to try and figure out if there's actually like certain time frames that matter more or something like that, right? I don't think that it would, 30 is okay. But I don't think that it would have as much use beyond 20 to 30 minutes. Because like the average meta order in the treasuries, I would say, is about 20 minutes per leg. Yeah. But that's also where you could also just put 10-minute R squared on cumulative delta. You'd kind of get similar sorts of readings. Where you say, okay, when it gets to 20.2, or sorry, 0.8. When it gets up to 0.8, that's like enough autocorrelation that it tends to back off. Useful for catching 5 to 10 minute pops when the 30-minute is above or below 50%. Oh, so you're using it more as a filter. Saying, I'm only going to go long if we are above 50%. See, I think I tested the reversal like way more, and but again, there was issues with testing it, right? We should get into testing that. Actually, I think I was just checking the other day, by the way. I should probably transfer things, but I was thinking about going and buying the data for us to do a momentum strategy with. Using isn't the word yeah, okay. Yeah, I got Oh. I also notice that extremes can be stopping points in the opposite direction of a trend. So if we're going down and it goes up to 70, that can be okay, like price going down, big pop to 70% buyers, and then price drops again and down to 30% buyers, and then oh. Wait, you've seen that? I had never seen that when looking, and that is not something that I would expect to be possible. But you're saying that when that happens, that price stops, or are you saying it reverses? So based on my kind of larger framework of how I try and trade and everything, something like that would be a strong contender for a reversal, right? Because what I would be looking, what that is, okay, we're having a strong meta order to the downside, and then all of a sudden a strong meta order opposing it shows up. So especially if that downside meta order then stops or becomes passive, those are the moves where like you're likely to retrace the whole move potentially. You know, if it's as big as the other meta order and the liquidity hasn't recovered yet, then it's likely to go further than the first meta order, right? And that's something that I'm kind of eyeing, is like, if we're going down and then all of a sudden I see this strong market buying come in out of nowhere, I immediately get out, because that's why there's this tendency for it to, like, you know, you lose all your profits on some of these really good moves. Happens less on the treasuries, and it hasn't happened nearly as much lately, but action plus reaction, jumping in, playing land prince isn't smart. I don't know. You know, can you, next time that happens, take a screenshot of it. This might be one of those. So I'm frequently coming into situations where I'm like, okay, I wonder if this, and this, does the market have a tendency to do this or this? And they're often things that I don't think I could determine algorithmically. Like this kind of pattern, I'm not 100% sure how I would identify it algorithmically. Maybe if I say there was, it touched 70, like I can say it's touched 70 and 30% in the same 10-minute window or something like that, and the trend was down, maybe that's how I could do it. But otherwise, it's kind of like you have to take screenshots of them and like do it all by hand. So like, let me give you an example of something that I think I would have to do by hand. Here's a theory that I have. If a Federal Reserve member says something that moves the market, then the market is more likely to move next time they talk. Like, the market is more likely to move next time a Federal Reserve member speaks on monetary policy and the outlook, but then it's also more likely to move next time that specific member talks about the economic policy and the outlook. So the only way that I would know to study that would be to go, you know, and look for every time that a Fed member speaks, and there's a move based off of that. And right, that would be, you know, if you were doing like a research study, then you could go and you could do that, because that would probably be months of like going through data by hand, figuring out what happened each time and stuff like that. Like, it'd be a big project, right? 30 minutes is below 50 now, but 10 is peaking at 60. So there should be selling reaction, but the magnitude of the reaction is up to, well, yeah. No. I think that, so what we should expect to see is the selling pressure subside, short-term mean reversion, and then it going flat. And at the moment, it looks like it's going flat at 11, right? That's what I'm seeing. But I'm perhaps on the 952 candle was where you saw a big imbalance in favor of buy. Yeah, I don't know. So like another way of thinking about this would be like, what would it have done to us at the beginning of the session, right? We were seeing a pretty strong imbalance to the long side, and I kind of ignored it and said, well, it's not in line with my thing. I'm more interested in the short side. We'll see if short side comes in, right? So like, if we were going just off of the technical, like with that technical indicator, would that have gotten us long, and then you'd get stuck and miss the short side sort of a thing, you know? Like, here's the, well, yeah, okay. Well, now you're saying something different though, right? You're saying that, that it can only go so long before you have to see a counter reaction of some sort, right? Like if it was going up really, really strongly you know, the longer the time goes on, the more likely you are to see a quick little bit of selling. I think I'm still at, I think I expect it to settle. I expect it to settle. The one caveat is that the market could read this continuation of yesterday's action as a really bad omen and just keep selling it. Essentially, the reaction magnitude isn't guaranteed, but it helps you time your... Yes. Lewis Hill, what I missed was the topic. Oh, we're talking about these kind of very short-term imbalances that we see. If you're short and the imbalance is dropping, but your price isn't, then get out. Oh, that's interesting. Well, yeah, that would be iceberging, right? Yeah, I guess you could kind of scalping. I mean, it's kind of more we're trying to dissect. We're trying to see, or I guess it's really more me, who's just reporting what he sees. I'm trying to see if I can fit what we're seeing in this one particular indicator with what we know about, you know, empirically proven properties of order flow, essentially, right? Would it be possible to get a tick on a daily basis with zero inverse movement? So what are you saying? You're saying I want to take one trade a day where I make one tick and I don't want to have any adverse excursion while I'm in that trade? Possible, sure. Realistic? I mean, with those kind of... so if I want to... I can't have a tick against me, or I'm going to, you know, get out at -1, and I need to get my fill on the other side, right? Your win rate on that's probably going to be 45%. Unless you have some really, really good edge that tells you, like, that the next tick is very likely to be continuing up, right? So we got our selling rack here. So there was at 10, was it 10? 10 half, 10. Some signs of low latent liquidity. So I would expect that to be kind of a magnet, but so far it kind of looks more like it's going to settle down here instead. I'm thinking about, so going back to something I had mentioned briefly earlier, which was, you know, maybe I should buy the data for us to go and test, do more extensive testing on momentum strategies. And the kind of thing holding me back is like, when would I do that? Well, I could do it here on stream. Then I would be showing you guys, and I don't know how I feel about that. I kind of think that particular thing would need to, I wouldn't want out. I can always do it on another screen, but then, like, that's no fun for you guys, right? Nobody can predict the next tick with 100% accuracy. You know, well, and I think the bigger issue is that, like, you know, trying to get fills. Because if I have, you know, if I'm short 09.5, but I've got 3,000 contracts in front of me to take my profit, like, that's tough. So I would much rather be short 10, but then I have 3,000 contracts in front of me to get filled at 10. Like, you see the conundrum, right? Like, if you're fast and you're at the front of the queue and you're like doing statistical arbitrage, then it's a different issue. But then that means that you're a robot. Is it the 30-year that leads, or would it be the 5 and the 10? So I think it's slightly more complicated than that. The first thing is that I do tend to find that, like, if I get a wave of orders, like, let's just say that all 3 of them, they tick up with a wave that hits all 3, usually they will hit the 30-year first. Like, the 30-year kind of has this tendency to lead by a little bit, but it's like so quick that you're like not even going to notice most of the time, right? Versus the bigger thing that happens is the yield curve, right? Yield curve seems to have momentum to it, just like the treasuries do. Like, if it's steepening, it's likely to continue steepening the whole day. It's very rare that I see where, like, there was a big move, it steepened a ton, and then it flattened a ton. I mean, that can happen during, like, news releases, but otherwise, it tends to just kind of move gently along. So right now we're steepening, which means that you're going to see the 5-year move further than the others, right? And so in that kind of a situation, you're going to see more market orders long over here, and you're going to see more market orders short over here. But it's kind of interesting because typically when you are seeing steepening, you're also seeing us move up, okay? Like, steepening and us move down is less common, let's say. I'm not going to say that it's like super rare, but it's less common, okay? But that is what happened today. The treasuries moved down, but the yield curve moved up. And so what are we seeing on that then? Well, on the move down, you're seeing pretty heavy selling in the 30-year. You're seeing it across the board, but it was pretty significant in the 30-year. Kind of seems to me like some of the bids are just getting out of the way here in the 30-year too. Was maybe a factor in that instance. So that's what I would kind of watch a little bit more is, you know, I have my indicator suite. You can buy it for $100 a month, but there's also free versions on the website. You go to speculatorseth.com. There's a spread indicator that's free. It's just, it doesn't like roll over. Anyways, put that on a chart, look at the spread, and then adjust your reading of the order flow based on which direction the spread is going. So if we're steepening and I'm seeing a ton of selling in ZB, or I'm seeing a ton of buying in ZF, that's not necessarily a reason for me to go long, you know, because they were all going down anyways. So I don't know. Today, not a good example, but you could have a situation where all of them moved down, but cumulative delta was rising in ZF. Does that mean that you should buy ZF? No. Right? Now, you can do things like it's giving us an opportunity right now. So do you see how the 10-year moved down a tick and the other two didn't? So that's not unusual because there is kind of like there's convexity in the curve, but that's a potential opportunity where I could say, if I'm able to catch the edge here at 09.5 and then catch it at 10, I probably have a better chance of getting filled there than, you know, other situations, right? So those are the sorts of things that you can kind of look at to try and catch one ticks. But I would say super hard, and me trying to do that was not enough, you know. I saw enough to say, okay, like there is something to this, but it's not enough of an edge to really overcome the larger things that go on. I don't know. When I was trying those sorts of things, I didn't really have as good of a handle on like what the flows were likely to be and stuff. So probably some of the like bad losses that really soured me to that could have been avoided by knowing what the flows were, right? So in this situation, I actually think that the one ticker from 09.5 to 10 might be okay. Let's just see. Let's just watch it and see what it does. The first thing is we'd want to catch the edge, so like have a stop order that if it goes below a certain amount. I guess I could do it on sim. So if it gets below 300, then we'll stop into it, right?
Block sell.
Nope, they sold instead. So we didn't get triggered. Okay. That was a big order. That order is unusual. Just to see something that big long after the initial move is over is kind of weird. Those tend to come out more at like the peak of a big move. That's the sort of thing that could make us get pinned to 09 though. When you say the 30-year, would it be UB or ZB? I would probably look at ZB more than UB, but you know, it could be either. You know, I'm going to be more interested in the instruments that have the most liquidity, right? So UB doesn't have nearly as much liquidity, and so I kind of feel like that the informational value that you get from watching it is not as much. So the 30-year has kind of come down a tick and is kind of balanced back there. So I don't think that you have the opportunity anymore. But let's watch. Okay, the UB did, as soon as I said that, UB ticked up too. That offer is holding strong. I don't know. This is just a good example of like, I might get triggered long, but I'll be 4,000 in line, you know? I don't know if it's actually a very good trade. The liquidity is thickening up now, though, isn't it? That's very, very curious to me. It's much thicker than it was yesterday, right? BlackRock's income and bond-focused funds have bought shares of the asset manager's spot Bitcoin exchange. Oh, what? That shouldn't be allowed. I guess it depends on which one. That concerns me. News squawk is too loud. Octavius is going short again? Really? Well, this one interests me a little bit more, Octavius, because I can't... I don't know what it is that would make you want to go short there. I am of the opinion that we're likely to rotate around 09.5 for the rest of our time here. Kind of browsing around here now. Oh, here's another one of those threads that I'm like, you know, if I was in charge of these subreddits, I wouldn't allow them. What are the best resources to stay on top of economic data for futures trading? Financial Juice. Financial Juice is the correct answer. But, you know, I make affiliate commissions for Financial Juice. So, like, would it really be honest for me to go and recommend them on Reddit without disclosing that? I kind of feel like there's a problem with that. And really, for all I know, somebody that runs one of these economic resources, like Econo Day, I don't know why people like the Econo Day calendar, but whatever, you know, could have told somebody to go on Reddit and post that, and everybody upvoted it. So, like, if I was in charge of those subreddits, I would just ban those things. I find it so backwards. On Reddit, if you ask for a recommendation on a service or whatever, that's all above board, no shenanigans there. But then if you create a piece of content and submit it to Reddit, that's submitting your own content, and then they won't upvote you. So stupid. It's like, do you not want creators to make good content for you? Right? And then people turn around and they complain that, like, there's not enough content about this thing or that thing. Well, yeah, because you make it so effing hard for anybody to be successful doing it. Well, 09 has become point of control for this session. Only 30,000 contracts out. That's not, you know, I'd say that that's pretty average for a point of control. So something I was saying here in the Discord, you know, that move to the downside felt pretty spectacular and was exciting when it happened. At least I felt excited when it was happening. But it wasn't that big of a move, nor was it that big of a change in cumulative delta. So it was just kind of a standard down move. I think that you'd be tempted to be like, oh, this is a big deal, or like we should be really concerned about interest rates rising from here and yada yada. I don't know. I think that it was just the imbalances for the day. Let's see what happens with the 7-year auction. If the 7-year auction is bad, like the auctions yesterday were, that's a problem. Because if the market cannot absorb the increased supply coming out, that's the sort of thing that starts to lead us into this sort of debt spiral problem, right? Here's a weird thread that's pertinent to my interests. From r/quant, why do people still want to be derivatives quant traders in banks these days? Here is my take. I want to hear if people disagree. The exotics derivatives business are shrinking since 2007. I worked in equities derivatives as a quant. I think the real exotics businesses are in perpetual decline. From my experience, the work is generally uninteresting at banks nowadays, and there are genuinely not that much opportunity to write models if you work in this sector. In my previous shop, the vast majority of juniors left in less than 2 years because they hated the work, mainly doing support, but no real exposure to the commercial work. For traders, especially the senior ones, I think it is worse. The juniors nowadays tend to be able to code, some very well. Some can find an out, and I have seen some did. However, with the latest redundancies in many banks, many senior traders suffered from the curse of seniority. The skill of a trader, I argue, is not that transferable, and many would struggle to find jobs. I think that is true. So it seems to me it is mad people still want to join this sector, but it seems so many people, at least on Reddit, are still keen. Okay. I don't know how it is on the banking side, but there's still a ton of money in derivatives in general. Equities has had a lull other than COVID and GME craze, but the other markets such as rates and indexes have been pretty active. I would definitely not agree that the skills are not transferable, but this is probably more a case in some particular roles than the role in general. If this is what you experience, I'd move firms. I work with a lot of exotics like Cliquettes and Asians. They generally don't do well during the kind of market conditions we are seeing. People can just buy call spreads and get significantly better returns for a little more premium. 5 to 7 years ago, those exotics were massively popular because the market conditions were giving great returns on low premiums. That can easily happen again in the near future. Your opinion is not supported by the facts. Notional derivatives value held by banks is higher than it was in 2007 and surrounding years. It only decreased from 2014 levels due to compression activity by banks to the tune of more than $200 trillion a quarter. The above-linked OCC report also shows that trading revenues are greater as a percentage of total bank revenues than they were in 2007 and surrounding years. But I want to know what they were in like 2018. Well, whatever. Banks are still very active in the derivatives markets and rank among the leading desks for trading derivatives across almost all underlying asset classes. Becoming a leading trader at a bank desk is lucrative. 7 to 9 figures yearly income and an excellent way to build a reputation that can lead to starting a fund and getting into the billions. Yes. How do I build a reputation that can lead to starting a fund and making billions of dollars? That's what I would like to do. That's what I would like to do. You have any ideas? Let me know. Do you have like $10 million? Let me know. We'll start a fund. I mean, for traders, I think it's pretty obvious. I started as a quant in a bank. A few traders were smart, some were average, most were mediocre. The average ones made $1 million a year easily if they stayed more than 6 years. And that's really high pay for someone with actually very little skill, no alpha, and who spends the day browsing Amazon and talking crap with colleagues when it's not too busy. Really. That's interesting. This kind of brings me back to like, maybe I could have been a good trader at a bank, but I'll never have the opportunity to find out, right? I think in many respects, the retail traders have to work harder than the traders and maybe understand the markets in some respects even better. Kind of depends on the kind of trader, though. Block traders, they know all the stuff we're talking about. Here we go. Not everybody targets for top-tier firms like Citadel, Jane Street, etc. Even every buy-side firm hires at full capacity. There are still people looking for jobs. For a lot of people, going to a top bank is a big upgrade. Reasons can go on and on. Yeah, okay. I think he's right, though, that if you're in the quant space, like working for Citadel or Jane Street is the ticket, right? At the moment, all I see is divergence, and it's difficult to read. Well, so this is something that, this is one of our strongest edges. It doesn't tell you what direction it's going to go. What it tells you is that we're not going to go anywhere. You see this line right here? You see this? So what you should expect to see, meta order, short-term mean reversion time period. In this case, it was like a bigger impulse, so it kind of came back down, but then what? Flat. Just goes flat. Because if there's not another meta order, then the market's just going to sit there and do nothing for 45 minutes, right? The liquidity at 09 is damaged. Latent liquidity, I would say, is damaged. We've been there long enough that we might soon break out. And who knows? It's kind of a crapshoot at that point, whether it goes out or out there. So for me, if I'm short from here, which is about the place that we were, well, that's where I took my sim trade. Wish that I had taken the live one, okay? I want to be out somewhere in this vicinity, right? So preferably I would have gotten out here, and that's around where I did. Okay. But when you get this and back, and then it's just like several bars going nowhere, yeah, don't trade that. There's no opportunity in that. It means the market has gone dead. It means the meta order is over. You either caught the move or you didn't. Now, if you're talking about the S&P 500, then it's who knows. They were down pretty strongly overnight. They have recovered pretty much all of that in the first hour. I suppose that if I was betting on E-minis, I would go long, but I don't really have a whole, trying to predict the flows over there is super, super hard. You hate ES and NQ? Well, good on you. I think that a lot of retail traders kind of hurt themselves by always going there first. Like, if you're trading E-mini, it's random, all your trades are you really learning anything? Whereas if you're coming over here and you're trading the treasuries and, okay, you're trading, you lose money, but you're following the Federal Reserve, you're following the news, you understand things that drive order flows, etc. And those are all things that you I think in the long run kind of get forced to do to try and trade this. Because over here in E-mini, it's like you can just take a trade and like there's a good chance that it's going to fill you. But over here in the treasuries, it ends up being so directional and stuff that, if you don't know what you're doing, you just get crushed. You just immediately get crushed, right? So you're so much more likely to learn stuff trading the treasuries than you are the equity indexes. I see all of these guys that they just, they trade the equity indexes for years. They struggle, and you talk to them, they know nothing. And it was just a complete waste of time for them. Whereas for me, we've been doing this for a few years. I've had periods, I've had profitable years and unprofitable years. But I would, even if I never made another dollar from it, I would still say that it was valuable knowledge to me. And I don't think I could say the same thing if I spent all of my time trying to trade the ES. I might try and convince myself that it is true, but... Whereas the things that I've learned from treasuries, I can quantify the improvements that it's made in my life that were outside of trading. Like, I knew after 2022 that, I needed to do more to increase my salary to keep pace with inflation and how to kind of navigate that. And I knew what the market conditions were. And so I knew where to look, and that helped me get a job that paid considerably more than my last job. I knew what was going on with interest rates, and I knew what was going on with the housing market, that housing supply was likely to be constrained in the future. And so I did everything I could to get into a house early. And that's hundreds of thousands of dollars that we're talking about there, right? It's been valuable knowledge. Knowledge that I would not have necessarily. Decisions that I might not necessarily have made if I was trading the S&P 500. How we aren't machines to put up with the random moves so quick. The treasuries is readable. Yeah, it really is. It is one of the things that I found frustrating about the E-mini is like, if you come in and you're only looking for like 4 ticks or whatever, then fine. You're just kind of gambling, I think. I think most of what's happening is random. So then if you go for something that's a little bit more meaningful, you're waiting for like a 10-point move or something. And then when it doesn't happen, you get super disappointed. And it's very hard for you to know, like, when is this going my way or not? In the treasury, I can see it. I can see like what is the market orders, the imbalance, and it moves slowly enough I can kind of see and get the pace of it. Whereas in the E-mini, it doesn't do that, and often you get moves completely contrary to the cumulative delta, which doesn't really happen the same way in the treasuries, at least not across all of the treasuries. So like, yeah, I just don't like trading equity indexes. This has come up many times in like Reddit threads and so forth. A couple of people have, said, oh yeah, me too. But equity indexes are still super popular. DNC to nominate Biden-Harris virtually and early, really. Equity futures is not the way to go for beginners. What's funny, though, is that it's heavily advertised by low margins, by clearing brokerages, probably looking for easy liquidation fees. Maybe. I would... My theory would be the opposite. I think that the brokerages emphasize the E-mini futures more because that's what retail traders are the most interested in, and that's the most likely thing to bring them in business. And why is that? Because we talk about the S&P 500 so much, and because it moves the most, right? It's kind of silly, though. I am kind of noting a possible change here in the 10-year. Like, that bid is pretty strong, but then it's just running into an iceberg at 09.5. Like, so you can really see where that latent liquidity makes it hard to move out of that spot. I think that it's probably been long enough that we could move away in the next 15 minutes, but it's going to be a slow mover. This is 75%, really.
Block sell.
Well, yeah, 4K. Almost, well, it was a 3K market order followed by like 1,700 other orders following it, but take it back down. I think that we're likely to move away from this 09 area in the next 15 minutes. It has been 45 minutes, so the liquidity should be healed. I would say when you look at it, okay, they had a pretty good bid there. They just got slammed. You got a pretty good offer. This bid is still holding up. Like, liquidity looks good now. The only problem is I don't know if the market orders are there, and there's still these icebergs on the edge doing stuff. So I think that we will break out from this area, but I don't think that it will be like a super worthwhile trade, right? Are you officially a full-time trader? Hell no. Why would anybody want to do that? Can you imagine, like, whether or not you eat tomorrow depends on whether the S&P 500 moves up or down in the next 5 minutes? Like, that just sounds like a complete nightmare to me, man. I think the further along this I get, the more I realize that the goal that most retail traders are chasing, which is I just retail day trade and that's my entire income, is really stupid. It's a terrible lifestyle. I don't know why anybody would want to pursue it. It's a bad trade. Right? The trade that you're making with your life is, I'm going to primarily pursue day trading in the hopes that makes me my income. That's my sole source of income. It's a bad trade. It's a bad trade. Okay. Coming in and saying, I'm going to start a momentum fund and make money from the management fees. That's a good trade. If you can get that gig, that's a great trade. But trying to day trade for a living, you're crazy, man. You're absolutely crazy. I guess what I'm trying to say here is that I would actually be more suspicious of the person on YouTube telling you that, like, they did that like that's their full-time job. You know what I mean? Oh, what do you do besides trading? I am a site reliability engineer. So basically coding, but coding that is focused around keeping the website up and running all the time. And, you know, debugging and being the first line of defense when things go wrong. The trade that I'm making is that I have all the time in the world to work on my... Well, there you go. What about, well, you know, I think it's really weird that everybody keeps bringing up SMB. I mean, do you guys have like 5 to 10 year metrics for their performance? And do you have a full, thorough explanation that matches the trades they've actually made to explain how they actually trade? Because I keep getting all these people saying, oh, well, SMB makes money and they use X, Y, and Z. And I'm like, do they actually use X, Y, and Z, though? You know, they might be using informational inefficiencies and not even realize it themselves. I've found a couple of instances like that. But it's just weird to me that they keep coming up all of a sudden these days. Used to, because SMB's been around for a long time, nobody cared. Another thing, SMB, you know, I think that they trade stocks, not futures. Yeah, I mean, I'm not saying that there's not anybody out there that lives full-time off of their trading. I'm just saying that if you're not living full-time off of your trading, that it's kind of a shitty trade. That I wouldn't put all your eggs in that basket. They trade Nvidia. There you go. You know, I'm keeping an eye on Nvidia. I don't think that I'm ever going to buy into Nvidia. I feel like that's one that I missed. I remember way back in my early days when I was kind of more focused on trading a portfolio. I liked all the tech companies. I liked Google, I liked Apple, I liked AMD, and I liked Nvidia. And I can remember, you know, AMD was always a bigger stock than Nvidia. And I remember when Nvidia was still like in the few dollars, right? Now, back then, I didn't really have the money to do it. More recently, though, you know, like I bought some things in 2020. I didn't buy into Nvidia like I could have. It was kind of on my list. I was looking at it, but it was just like, it wasn't the thing. It wasn't sitting there. I was like, oh, that might be a good stock, but it was never like, that's going to be that's the one. That's the ticket, right? And now it keeps going. And it's just like, how do you even value this? Like, how do you have something that becomes so crazily and seemingly overbought and then still blow out earnings and continue going up? That makes no, like, I didn't realize that something like that was possible. I think with our understanding of markets, it certainly should be possible. It's just not something I ever expected to see. And so now, like, where does it actually go? My intuition tells me that at some point, the AI bubble bursts. People realize that they're putting way too much investment in the infrastructure to do this kind of artificial intelligence training. And NVIDIA will come back down to earth. But when that happens and at what price, I have no clue. I remember AMD at $3. Yes, I remember AMD at $3 and $4 and thinking that's too cheap. Yep. Wow, at 23 at the sell. Well, the sell that came through here isn't bad. I don't know. So, like, what I'm seeing is like another leg of the meta order. It kind of looks like it's already petering out. So I'm not sure that they have enough to make another new low. And also, because of the timing of it and all of that, I doubt that it's actually related to the first meta order. So I'm a little skeptical about how far this one goes. But I mean, they are pushing the bottom side of this. It looks like they did tick by about 20 contracts a new low. So let's see how far they can get. But I'm not going to try and jump on board it. Dude, go and check Super Micro. Yeah, that one's crazy too. I don't know. I feel often like Warren Buffett, where it's like, okay, I can remember after 2008 looking at a bunch of different stocks and being like, here's opportunities and here's opportunities. And I probably would have made a ton of money on any of them. I don't know if I would have picked the ones that performed the best per se, but I probably could have made money on any of them, right? And now, ever since I've kind of had more discretionary income to kind of make those sorts of plays, I'm not seeing that same sort of thing. I'm not seeing this company that's like, well, I think that this is a really good company, but its stock doesn't seem to. The only one that I can really think of, that I can really think of, is Intel. I think that at some point Intel will catch up. I view it from 330 to 1135. Same with Bitcoin. Well, so I've been following Bitcoin from the beginning, and I've always kind of despised it. And I've always kind of thought that it will probably continue to go up, but whether I can pick a good spot to be in on that, and if it's worth my money, and do I really want to contribute to that? I think not. Can you imagine if I had gotten into Bitcoin at the very beginning and became a millionaire from being Bitcoin? Like, would I have gone into any of these other things? Would I know any of these other things? I kind of think of the person that got into Bitcoin and was successful with Bitcoin, and I despise that person. Like, I'm glad that I'm not that person. Who's your broker? What version is that Jigsaw that you're using? Yeah, so I'm using Jigsaw Day Trader. It's the latest version. It's 4021. And for my my introducing broker, I use EdgeClear. So I use EdgeClear with Rhythmic data. And then I pipe Rhythmic into NinjaTrader with kind of a little jank setup I have with the... I have a developer license for NinjaTrader, but I don't use it. I just use the demo one because that gives me access to Rhythmic. They backed off at least one tick from those lows. I'm still, in fact, I'm starting to see counters. I'm kind of wondering, let's just watch this, but you know, like Uzi is saying, you tend to get like really strong imbalance. You're going to tend to see like it hit back the other way really strongly. So I'm wondering if they've got oomph to kick it back into 09 or not. At the moment, it still looks kind of heavy. A quick profit does not establish a foundation of knowledge, eventually leading to the collapse of the person without. Exactly on why average lottery winners go through all of their winnings in 2 years. Yeah. Well, it's not even knowledge. So you want to hear a dirty secret? I keep thinking like I should go on TikTok and make this video, but then I'm like, TikTok hates me. I don't know if this video would go anywhere. But my hot take is this. Having a financial education is way overhyped. So there's all these people out there that are like, you know, you're poor right now, and in order for you to become more rich, you need to be able to make better financial decisions, and so you need a better financial education. And then they teach you things like, here's what an index fund is, and here's what an IRA and a 401k are, and why you should be investing into those and all of those sorts of things. And okay, cool. Now you have a financial education. And then guess what? It doesn't do jack squat for these people. Not only do they not end up making more money, but they continue to make poor financial decisions and spend money on things that they shouldn't. So why is that? I'll tell you why. Here's what I think it is, at least. Having a financial education is worthless. What you actually need is you need financial experience. That's the key. So, if you have a small stock portfolio and you pick 5 stocks that you want to buy and hold, you do research on them every week to keep up on what's going on with that stock. You get out of the stock if something fundamental to your thesis for why you own that stock changes. You get out of it. And you manage that over years and years. You're reading the financial statements. You're reading the quarterly reports and all of the news stories about that company. You do that for years. That will give you financial experience. So as you're doing it, your brain is modeling that out and setting up brain pathways and things to help you make those decisions and do them better in the future. That's what you actually need, and that's what leads people to, becoming financially savvy and then being able to make these better decisions that actually make them big amounts of money. Right? If you just sit in a classroom and you learn all of these things and you don't do anything with it, or you learn all of these things and then you put all your money in an index fund, you don't learn jack squat and you just stay where you're at. Man, you know what, Octavius? I don't know how I feel about that one. Because you sat in that for a long time in the hole, right? That last little stop out to 06 though, it sure was spectacular, wasn't it? Reminds me of Skin in the Game by Nicholas Leb, explaining that people that sit on the sidelines aren't so much wiser than the ones actively in the trenches. The imbalance called it? Well, but did it? I mean, are we saying that if you get an imbalance to that level that you should go short? Is that what we're saying now? I don't know. I don't think that we should say things like that unless we really have a solid back test to back it up, right? So what are some things that could have told us that this was going to happen? Well, so let's kind of go back to our framework of what we know about the way that the market works. All right. Oops. Hold on a second. You're going to tend to see large meta order. They're going to form a liquidity hole, and then they're going to execute in that hole. That hole is going to last about 30 to 45 minutes. Okay. Now at that point, if the large meta order sell is done, then they're just going to range around here. And that's kind of what I thought. I thought that we were going to just rotate around this, right? But instead, we got another leg. I was skeptical about how much there was in it, but they're still going. So we'll see how long this leg actually ends up being. So far, it's been from 25 to 43. So that's like another 20K selling. So now we're at the point of we are getting way more selling than we anticipated from over here on this. Okay, what's driving this? Okay, oil is going down, so it's not oil. The Japanese yen is going down. The Japanese yen is getting savaged here. Oh man, yeah, the Japanese yen does not look good. So it could be the Japanese yen. It could be some other dollar movement. I mean, the dollar looks pretty strong. It could be momentum. I don't know if that's what that is. Stocks getting kicked in. I don't know. My guess, based on the flows that we know here. Okay, so we're not getting JPY intervention, so I don't know what that's with. Is it the German overnight CPI? I don't know if that's this big. These guys haven't come through yet. Richmond Fed. Oh, we did have the Richmond Fed. What was that one? I wasn't even paying attention. They got 0 versus an expected -6. Okay, that would kind of push us down as well. 7-year auction. And that's the one that kind of sticks out to me. It's like, is the 7-year... We're getting like a big concession now. So is the 7-year auction kind of struggling here? Well, maybe they've given enough of a concession that now when we have the auction, they'll actually be okay. But it's because I added to my TLT position. You might be right, Uzi. It could totally be that. Who knows? I mean, there are situations where one order could make the difference and cause a chain reaction of things. But nah, I think that it probably is the 7-year auction. And that concerns me, if that's what it is. Right. Like with this concession that we've given now, and then what is it going to be in 2 hours from now? The auction goes really poorly. That's a very negative harbinger. That because we thought that the amount that they were going to offer, it was less than the market was anticipating. It was all of these things. Like the market should be well prepared and positioned to be able to take on this additional supply, and yet we're not. That's like a huge shift that would have very negative impacts for the market. I don't want to say that like these last 3 auctions tells us everything, but like it's not a good omen, right? Every time I add to that position, I need to sell the futures. Oh, yeah. So maybe it's the auction, but overall, way more selling than I was anticipating because I was not expecting another leg. So now they're probably getting to the point where they're probably going to build another liquidity hole. At that point, can they do it again? Can there be a third leg? I don't know. Well, I don't know if there's enough time to do it before the auction, at least. So, no. But, you know, I made a good call earlier. I wish that I had traded it live and did not. By the way, how much would that be? Well, we're at 7.5, so that's 25.30. Okay, so that last little shuffle actually wasn't that big in terms of yield. Still. Good opportunity that I didn't see coming. It's okay. Now, oh, well, okay, so going back to what Uzi was saying, like 30 minutes is still below 50%, but now 10 million is peaking at 67. So there should be a selling reaction, but the magnitude of that reaction, oh no, wait, that was the Octavius went for a short, and then fairly shortly after that, you did see some selling come through that was kind of like really short-lived, right? And then it kind of flattened out, and then they puked and we went a lot lower, right? I still don't know what could have prompted him to get into that trade. I don't think that it would have been anything in the order flow, but that's it. Reminding me that I need to go to my day job now. How much is the day trading platform? So it's about $500 to buy the platform and then $50 a month to enter live orders. Well, it's not cheap, but you get what you pay for. All right, guys, I got to get going, and we'll see you guys tomorrow. In the meantime, stay excellent, team.